We want to continue this Fed reaction here, 25 basis point hike. For that, we want to bring in Sarah House, Wells Fargo senior economist, and Michael Kushma, Morgan Stanley Investment Management Chief Investment Officer, Broad Markets Fixed Income. Great to see both of you. Sarah, let me start with you because Wells Fargo, the larger thinking there from you guys was that we were going to get a pause at this meeting. We got a 25 basis point hike. Was that a mistake?
No, I don't think it's really surprising. So we were saying it was a very close call and neither outcome would surprise us. But I think what we really saw here is that inflation remains the predominant concern among the FOMC. So you saw that with them hiking through this disinflationary event, the extent to which remains to be seen. But I think overall, the additional tightening we've seen in financial conditions does speed along the disinflation path ahead. But even through that hike, we saw the Fed raise its projections for core inflation, both this year and next. So I think we can certainly see that concern about inflation, which I think squares with their interest in going ahead with the hike today.
And Michael, your reaction to the 25 and to the language of additional policy firming ahead?
I think it's consistent with the idea that of late, prior to this financial market instability we've witnessed in the last couple of weeks, the data was running much hotter than expected, whether it's inflation data, labor market data, spending data, even housing data was getting better. So instead of the 450 basis points of rate hikes last year slowing things down, it looked like in the beginning of Q1 that the economy is accelerating. The Fed of Atlanta is now casting for Q1 GDP is running over 3%, probably going to come down. But things were going the opposite direction as desired. In some sense, a credit contraction, a credit or reduction in credit availability in the economy is probably important to have in order to hit the inflation target. So I think that with a month in between the next meeting, and reiterating their confidence that inflation is job number one, we can deal with financial market stability with other tools.
Sarah, let's dig into that inflation fighting question a little bit, because we've been talking to some economists, market watchers who have said, well, if you look at the last inflation report, a lot of it was shelter inflation. And, that's stuff that's starting to come down. So how much more are we going to have to see the Fed tighten from here, especially given the lag effect on inflation?
Yes, I don't think the Fed has much further to go from here. So we were looking for a terminal rate of 5.25, which the dot supported today. And I think why the Fed's still only looking at perhaps going just a little bit more is those lagged and cumulative effects which they've been stressing for a number of months and continue to stress today. And to very much extent, we saw some of those effects over the past few weeks. And so I think that the Fed realizes that the inflation data is somewhat backwards looking, but I do think they need to see a bit more downward momentum than we've seen over the past few months to feel confident that they can at least hold policy at an elevated level for some time and wait longer for inflation to move more discernibly lower.
Michael, do you think that this decision here from the Fed and the language that we've gotten so far ahead of this press conference here in just about 15 minutes, is it enough to kind of calm some of the jitters out there in the market that have been very apparent over the last couple of weeks, given the instability in some of the banks?
I think that it's important for them to reiterate once again that inflation is problem number one. The reason why we have high interest rates is because we have high inflation. The reason why we have banking sector issues, if it's because of high interest rates, it's because of high inflation. We can't get rid of high interest rates unless we get inflation down. So that is job number one. Obviously, we have to keep tabs on what's going on in the broader financial system to not cause an accident or a crisis, a true crisis down the road. But on the other hand, the economy's been very robust. There's no signs of issues in the money markets, general collateral, repo rates, OIS versus the other measures are all perfectly in range where they should be. So I don't think there's any sense of a crisis. There's pockets of problems around which can be dealt with by Treasury and the Fed, and that they need to focus on an inflation. And this is what they are doing.
Sarah, to Michael's point, and this is a point Brian Belsky was making too, and this is a point the Fed seems to be making too. It says the U.S. banking system is sound and resilient. We're going to get tighter credit conditions. The effect of these effects is uncertain, but it doesn't sound like they're alarmed. Is the banking crisis over? Was it really even a banking crisis in the first place?
Well, I think we need to be cautious in terms of whether the stress is truly and fully removed. But I think we've certainly seen some of that stress be relieved over the past couple of days, which I think gave the Fed the green light to go ahead and hike with today's interest rate. And I think when we overall step back and look at the banking sector, it is strong. If you look at the cash assets and the liquidity positions of the banking system, it's significantly higher than what we saw in 2008. Same thing with capital. And I think, when you look at the what we were expecting for this meeting, it really was just to take a breath, a true pause. And I think given the inflation backdrop, the further tightening is warranted. It just seemed like, okay, it might be just a little bit too early. We want to make sure that the medicine takes before we saw that additional tightening today.
Michael, is the probability of a recession greater now than it was 3 weeks ago? And how do you expect, if he's posed that question, Mr. Powell will handle it?
I think it has to be at the margin because this issue has to affect the banking system as a whole. If they tighten up lending standards further, they reduce credit creation, maybe it's less profitable, the cost of funding, the balance sheet goes up. So I would think that the credit creation process in the months ahead is likely to be slower than what it was prior to the events of the last couple of weeks, which should help the process of disinflation. Remember, the Fed has probably been very surprised that the economy has been as strong as it has been, that inflation hasn't been fallen further, that growth hasn't fallen further, the unemployment rate hasn't really risen yet. It's probably surprised by all those things. So a reduction in credit growth over the next couple of months and quarters, it probably helps that process as long as it's orderly and it's not like stopping people from borrowing money who should be able to borrow money.
All right, got to leave it there. Michael Kushma, Sarah House, appreciate that.